Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, here we are, Jim, and it's always our welcome Friday.
Bob, we'll start off the show with a listener question. Joshua Ginsburg asks, I wanted to see if Bob thinks real estate will go up or down in an economic crisis, and if farmland would also be a good hedge in a financial crisis.
Whoa, yeah, that's covering a couple of important issues. And, residential real estate for sure has a tendency to go up in financial bubbles. The 1920s in the U.S., the really crazy speculative market in real estate was the Florida land boom, and it peaked. I just looked it up the other day in late 1925, and then was declining. And then in 1926, a terrible hurricane hit, so that was all over. So that wiped out a lot of equity, but it didn't really change the pattern of the 1929 top. But definitely, real estate prices did head down with the contraction that followed. The main problem is that the senior currency, which is the U.S. dollar, tends to go up as everything else goes down. And actually, mentioning farmland is good because one chart I came up with, it was farmland values in England from the top of the bubble in 1873 to the bottom of that depression in 1895. And the index of farmland values virtually went down every year for 20 years. And I think I think an index that just out of my head here might have fallen from 58 down to 35 or something like that. Which was remarkable. A long, steady decline in farmland values, and it happened. So I think yes, it can go down in all forms: real estate, residential, industrial, commercial, and farm values. I think farm values in the U.S. are already heading down. The prosperity is going out of the business. Their costs are going up, and their prices for agricultural products are going down. It's not a pretty sight. And thanks for the question.
We'll have more with Bob Hoye right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, Treasury bills, a 3-month Treasury bill, there's action there. What's happening?
Yeah, I looked at that this morning, and it's been declining quite sharply. Only a week ago it was at 2%, and now it's down to 1.80%, 20 basis points down, and that's a new low. And the importance of this, Jim, is that in 1929, the 3-month Treasury bill rate, of course, goes up in a boom. And in 29, it went up until that May, and then turned down, and distinctively down. And in retrospect, it was easy to say that then was saying that the boom was over. And the argument I've come up for it is that in a highly speculative mania, everybody's getting leverage, so that just the demand by traders for short-term money would put up short-term rates, and then the urge to speculate sort of tops out and eases. And then comes in the other part where very careful money will go to the most liquid items and the safest items, so that the most liquid items, of course, are U.S. money market stuff, Treasury bills shorter than 1 year. And gold is also a very good place for liquidity. So I think we're at the point now where the careful money is really heading to Treasury bills and driving that rate down. And this, of course, will force the Federal Reserve to drop their administered rates. And so on this year's action, the Treasury bill rate went up until March, the 3 months, and then turned down distinctively, and we've been writing about it frequently, that this was indicating that the boom was likely over. And then with today's sudden and distinctive decline, you've seen the stock market go from up in the first part of the day, and then from about 11:30 New York time, turn to decline. And also early in the day, I thought it was curious that the bank stocks, the BKX, were up quite sharply. And then now that's heading down. So the Treasury bill market is saying there's troubles ahead. And then this was the lead on eventually today with the market weakening in the latter part of trade. So it'd be interesting to follow this. Because also in the time of year, in the fall, when financial distress can be discovered, like all of the mistakes were made during the fun and dramatic part of a bubble, and it becomes so compelling, everybody gets leveraged up, and then all of a sudden the prices stop going up, and the most recent buyers leveraged on a bubble, they need to have the price go up in order to keep them on side. So then the process starts going the other way, where then the most recent longs can't support it and they get sold out. So I hate to say this, Jim, but I think we're in the moment when the real power in the marketplace is shifting over to the margin clerks at brokerages and the equivalents at banks. And their job, quite simply, a margin clerk is supposed to make sure that the accounts are in line, like there's enough equity in the account to support the leverage. Whereas what we've seen with very reckless central banking, trying to promote things up like inflation up and bonds up and stocks up, the promotion by central banks has been very reckless. So it's not unkind to say about central bankers that their job description has become to get the accounts out of line. But this is where then the power, when it shifts over to the margin clerks, they overwhelm the central bankers every time. Now, certainly a week and a half ago, the Fed did move in the repo market and provided huge amounts of liquidity. And that was then the sudden discovery that, hey, the liquidity had disappeared. Oh, and Jim, this is worth a mention as well, that in a highly leveraged market, you've got bids for everything all over the place that gives the appearance of a very liquid market. But the problem is that when it's leveraged, there isn't any real liquidity there, and this is why it becomes very volatile. So our view through the action this year would have been positive as we were using the term sunshine out to around mid-year, and we would use that, the favorable markets to sell into to raise liquidity. And then the other metaphor we used was that in August, you could maybe the sunshine would turn to twilight, and then with that hit in the first part of August, it did. And then after August, we could head into the old scary TV show called The Twilight Zone. And the move by the Fed on repos to provide liquidity is not a heroic action that will save things, but it is the first sign of distress hitting the New York market. And then, as we talked about earlier in the year, when we noticed that Argentina and Turkey, their central bankers were running out of reserves and had to raise interest rates, and their currencies got into trouble, and noted that this eventually would hit New York. And then later on, sort of April, May, you had the same story coming out of India, where suddenly things are becoming adverse, and then out of China. And the China talk was that, they were going to devalue their currency relative to the U.S. And then I was sort of thinking through July that this was a policy determination. And then later in August, all of a sudden realized, hey, no, this is part of the process of outlying exchanges discovering that there's no liquidity and their central bank reserves are disappearing. So this is what it is. So this is now set up to hit New York, and it is hitting New York. And today's decline in the 3-month Treasury bill rate is a very concerning indicator.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, share buybacks hit record levels over the past year and a half. Were companies wise to buy back their shares?
Oh, boy. That's a game that started before the big boom got underway, when you had 8 or 9 years of pretty slow economic growth. So they started doing stock buybacks, and that was helped by the interest rates for borrowing money for corporations was very low, and so they started buying stocks. Now, I just saw a study on that since 2011, thanks to the stock buybacks, what happens, you buy the stock out of the market, and then that cancels the number of stocks outstanding, so it lowers the number of shares outstanding, and your earnings stay the same. But when you report earnings per share, it looks like they're going up. So you've had, this report had that since 2011, earnings per share were up 360%. But they're on top of economic growth. The revenue growth was only up 50%. So they got 300% of apparent increase in earnings per share. So it's very dangerous. Now, part of this is driven by a good portion of executive compensation comes through stock options. So they get very focused on the stock market because their options are probably making a whole lot more money for them than their actual salaries. So here you have this back in the 80s when Tokyo was the darling and stocks were flying and they were doing the financial engineering where money for speculative action seemed to appear out of thin air. And the Japanese term for financial engineering was Zytec, and that's what this is. But you end up with some nasty things going out there. Like Boeing, for example, has been very ambitious in stock buybacks, buying billions of their own stock, which, as I said, financially engineers earnings per share up. And then they were very thrifty on doing the software for those 737 Maxes, and you then had serious tragedy, pathetic tragedy there, when perhaps $100 million could have been spent in software rather than buying back stock at extremely high prices. And then this is the other part of the issue, is that stock valuations relative to GDP or relative to the average wage in the U.S. became exceptionally high, even very much higher than in 2007, and even higher than in the dot-com mania in 2000. So, and then also this year, there are times you've had high momentum readings and high sentiment readings, which you only find at or near the tops of a bull market. So everything was in place through the summer for the discovery of a probable liquidity problem in the fall. And this is what we have. This, Jim, it is very serious.
Have the big banks just received a big break or a possible break?
Well, that was the other one that we noted, is that they, on some regulation, they reduced or talking about reducing a regulation, and this gets into policy. For example, in the first great financial bubble, the South Sea bubble, as it brewed up in England, South Sea Company was a quasi-government company, and between the speculation with that stock, there was also retiring government debt, which was in a bad situation. So governments and speculators were making money out of it, and then came the new issue market, where there were suddenly many, many tens of 50s and hundreds of new issues coming out, and the government saw that it would reduce the amount of money going that would bid up the South Sea Company stock. So they came in with the Anti-Bubble Act, where nobody could come up with any new issues. And that got through the House of Commons, but it didn't get through the House of Lords. And then by the time that it was time for the next great financial mania, which blew out in 1772, they took that law off the books just in time for the party. So then moving ahead to more recent times, is with the 1929 crash. At that time, the executives and bankers and policymakers knew that the crash was caused by the bubble, the degree of speculation. So they came in with a couple of measures to prevent another bubble. One was the Securities and Exchange Commission, and with proper accounting and policing, another bubble wouldn't happen, another speculative mania wouldn't happen. And then the other one was that they then came in with the Glass-Steagall Act, which then separated regular commercial banking from Wall Street banking. And that was a practical measure. And then, of course, by 1999, so many of the banks in the U.S. had become Wall Street banks, that they just took it off the books. So here and then this other step, I can't remember the exact detail on it, but what had happens is that the recklessness is the feature of a great bubble, and even by banks or insurance companies, any kind of fiduciary agent become absolutely reckless. But then, because of the harm done on the previous example, where they put in, let's call them anti-bubble measures, and then when everybody wants to party, they take them off the books. So this is incredible irony, because if we do roll over into a bear market and a contraction, then all of the big government people will say, oh, well, if there were regulations, it wouldn't have happened. But there's nothing anybody can do to prevent a contraction, and this has been proven by the Federal Reserve itself, because in the early teens, 19-teens, those promoters behind the formation of the central bank, called the Federal Reserve, they were convinced that with the Fed as the lender of last resort, that would prevent the financial setbacks that precede recessions. So their theory was, lender of last resort, financial setbacks would be eased, and there'd be no recessions. That was the theory. And according to the NBER, which is the agency that determines the business cycle, there's been 18 recessions since the Fed was formed in 1913. And for this old physicist, hey, it doesn't work. So here we are, probably at the start of another one. We definitely have the financial distress, because the Fed is moving on repos, which will be inadequate, and T-bill rates are dropping. So I think we're into financial distress, and that will then force a recession. So again, probably recession 19 coming, of which, according to the theory in 1913, would be prevented by the Federal Reserve. So completely bogus and not working. But this is where I think the public will see that the trillions of dollars that the Fed has risked in fiddling around with the markets is actually taxpayers' money, and it was spent to prevent bad things from happening. And if you're into another recession, the folks will see that as a bad thing, and could very much condemn the nonsense of an interventionist central bank. So we do live in interesting times.
Bob, thank you so much for chatting with us.
Well, there we are, and it's Friday, and I'm looking forward to the weekend. What about you?
My wife retires today, and we're going out for steak and lobster tonight.
Oh, that'll be grand. Well, wish her all the best, and enjoy some nice wine with that as well.
The Faculty of Medicine at UBC will miss her.
That sounds great, Jim. Okay.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, and as you see, we do answer those questions, you can send them to info@howestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.